Good afternoon. Welcome to the webinar, The Great Reallocation, the Future of Financial Capitalism in Europe, organized by two Dutch think tanks, so Ceros and Sustainable Finance Lab, in cooperation with the Goldschmieding Chair at the Free University in Amsterdam. I'm Jan-Pieter Balkenende and I will be the moderator of this webinar. Let me first introduce the context of this webinar. Why are we gathered here today? We want to contribute to the ongoing debate on the future of the market economy in Europe. Together with Professor Govert Buys and a group of researchers, we are writing a comprehensive report on the future of capitalism in Europe, which will be published later this year. There have already been many conversations, also here in Pakhuis de Zwijger, that have been used as input for this report. The webinar today will also function as input. However, as this report is a European effort, we do hope to start a conversation with some of our counterparts abroad, organizations, corporations and individuals that are engaged with the same kind of discussion on the future of the market economy in Europe. Therefore, we are very glad to host this webinar with two French think tanks, the Institut Montaigne and Comité Médicis. Let's hope that this webinar is a starting point for more conversations as we progress with thinking and writing. Before I shortly introduce the theme of this webinar, there is one more important remark for our audience. If you wish to contribute to the discussion or ask a question, please feel free to do so. You can enter the Zoom on the webpage of this broadcast and state your questions there. And your questions will be forwarded to me and I will try to bring them into the conversation. So, the title of this webinar is The Great Reallocation, the Future of Financial Capitalism in Europe. And why this theme? Because Europe faces many urgent challenges for the coming post-COVID period. One of the most pressing challenges is how can we ensure that productive investments are allocated to organizations and companies that can contribute to real economy and the common good, climate, inequality, innovation, infrastructure, etc. And also very important, who can and should take the lead? Governments, businesses, financial institutions. Due to a private matter, Mr. Sebesta from the Konrad Adenauer Stiftung has had to withdraw from the webinar on the last minute notice. That's of course very unfortunate, but we hope to continue the conversation with the Konrad Adenauer Foundation on a later moment. And this brings me to the first presentation by Mr. Stanislas Potier. Stanislas Potier is a senior advisor to the general management of Amundi in Paris. Earlier, he worked at the French Ministry of Finance, the World Bank and Crédit Agricole. He was also advisor to Ministers Thierry Breton and Christine Lagarde, and former Prime Minister Michel Rocard. He joined Amundi, the largest asset manager in Europe, in 2018, first as director and now as advisor. As part of his advisory work for Amundi, he has written an impressive report called Responsible Capitalism, an Opportunity for Europe. The question of the allocation of resources for the financing of responsible growth is at the heart of the report. And we are therefore very glad that he is here to tell us something about his report. Mr. Potier, the floor is yours, and you have 25 minutes.
Thank you very much, Mr. Balkenende, and good afternoon to everyone. This is really a treat to have this opportunity to share with you and during the work you yourself carrying out on responsible capitalism and new capitalism in Europe, the report we've published now nearly a year ago or so, the last fall, on responsible capitalism, an opportunity for Europe. Maybe before presenting briefly its content and our main proposals, let me go back to the context and why we did this report. We thought, and we thought during the sanitary crisis, COVID crisis, that we were in a new environment, and this environment was at the same time a big challenge for Europe and also an opportunity. So we had an opportunity to play a game and we proposed a way to do it. So, what is this context? First, at the geopolitical level, it's true that today we have this is no, a discovery, multipolar world, and not entirely dominated by the US as it used to be some decades ago, and sharing the place with some other countries in Asia, Europe, of course, and with a tendency of the gravity center of the world to shift to the east. So that's first thing. The second also is, of course, industrial mutations and transitions. So we all think about the focus put on climate and the urgency we have to fight against climate change. This affects, of course, industrial processes, value chains, and all that. And at the same time, we got an acceleration with COVID crisis on the digital transition and digital revolution. So we also had a new intensity in social questions. Well, this was particularly true in France, but not only in France, and cohesion questions, and that raised the questions, for instance, of how do we manage the climate transition, the energy transition, to which extent is it acceptable by populations, which is of course a condition for its implementation. And maybe the last not least, a big move, again, not really created by COVID, of course, but accelerated by COVID crisis, is a new perception of corporates. Corporates are more political today. We have big expectations from citizens, big expectations from political and regulatory authorities put to corporates so that they contribute also themselves to public goods. And so they have to consider now a wide range of stakeholders, and not only shareholders. They have to make decisions, strategic decisions between these stakeholders, and they also have to think how they fit to societies and expectations put and arbitrated by democratic institutions, by this society. So if we also think 1 minute about the energy transition and digital transition, we have to be aware that these are really industrial questions. And Europe has been very naive many times in dealing with these issues. If we take one example on the energy transition and CO2 questions, CO2 emissions, we really run into, for instance, renewables. And there were a lot of subsidies put forward by different member states and by Europe for this, but we didn't pay attention to to maintaining our own expertise, our own value chains, and sovereignty on some key actors in these sectors. So at the end, we just subsidized foreign actors, and mainly Asian actors, themselves benefiting from social, environmental, and financial dumping. And we also ended in not being efficient worldwide level, because actually it was just a shift of CO2 emissions. Instead of having them in Europe, we got them elsewhere. So how do we play the game if we take stock of all these of this environment? Europe has to refocus on its own model, to be aware of the values attached to social economy, which is at the base of the European model. And this is, if we have to defend our model, we only can do it with an adapted capitalism and economic system. So to what extent can we remodel the capitalism in Europe so that we make sure that the abundant savings in Europe are really channeled to responsible corporates with the help of responsible finance? How do we make sure that this happens? And this is, of course, very important for Europe, but not only for Europe, because this is the model, not exactly the same as the Northern American model, and of course, very much different from the Chinese model. And some other countries in the world are also interested in our model. So there is a responsibility for Europe in being aware of its own model, its own specificities, and defending it, reinventing capitalism. So if I come to the report now, I think that we focused on the first chapter on the state of our economies and financial markets. And so if I'm quick on that, the situation is that we have abundant savings. We have, this is normal. We need them because we have an aging population in Europe, and we're also confronted in very big challenges on the energy transition, the digital transition, and all that. And of course, public health also challenges. So how do we make sure that we got the money to face these challenges? And this money goes to responsible corporates. If we take only one figure, maybe, to compare ourselves with the US, roughly in Europe, you have around 10% of public savings invested in shares and in corporates directly. In the US, it's more around 30%. In France, it's close to 6%. So there is a gap, and to put it very simply, we should make sure that we invest less in public bonds and more in corporates. And when we say corporates, it's not only, of course, big corporates that have access to financial markets, but also medium-sized or small corporates. How do we make sure that we create also local networks of savings going to local corporates, also able to sustain local expertise and employment and dynamism in territories. This is absolutely essential. Most of the time, you will see in the different examples I take and our proposals that the industrial and environmental challenges are absolutely intertwined with the social challenge, and that we have to deal with them at the same time. Otherwise, it won't be accepted, transitions won't be accepted by populations, and we will fail. So, and when we talk about of course, social questions, but I'll come back on it. It's mainly employment. I mean, at least first and foremost, employment and the contribution of economies to the welfare of populations. So to do that, of course, we made several proposals. Maybe I'll come back at the end on proposals. But to make sure that the money goes to responsible corporates, we have to identify the notion of responsibility. So what is it to be responsible for a European corporate? How can finance identify the right corporates in which they will channel finance or investments? So here we come to data, and we come to information and accountancy. So we have at the same time an issue on classical financial data reporting and accountancy. So we say that we are, of course, way too short-sighted, short-term sighted, and that we should change the accountancy framework. Again, I'll come back with proposals on that. And there is a second aspect on extra financial data. So now if we focus on extra financial and ESG, what was already rather political on financial and accountancy data is even more political, because here we're dealing with the relationship between corporates and societies, corporates and states, regulatory authorities, and the contribution to public goods, and the way we identify indicators, priorities, and the way we ask corporates to report on it, and maybe sometimes to integrate these data into the general accountancy system, of course, it will have an impact on the kind of corporate we push. The way we will have an ESG, for us, or extra financial framework in Europe is absolutely key to our definition of responsible corporate and responsible capitalism. And here again, we shouldn't be naive. There is a commercial war at stake today, and also a political one. And if we want to fight for our European model, well, we have to be clear on that and to play the game. And the last aspect of the report is more juridical, and we say that we should also be more go further down on an harmonization of the juridical framework of corporates and also of financial markets, and that we should also generalize in Europe some initiatives that we've already seen, for instance, in several countries such as Italy, France, or the UK, on the value chain and what is called in the UK, for instance, Modern Slavery Act, but what is called in France also the regulation we have to make sure that corporates look to their value chain and how do they ensure that they also deal with corporate suppliers, responsible suppliers. So this is very important. Another point is, of course, purpose. When we say that Europe should be at the forefront on responsible capitalism and identify responsible corporates, the notion of purpose, which has been pushed in several countries in Europe, but also pushed in the US, but in a certain aspect, should be pushed by Europe. So to give the opportunity, the possibility to any corporate in Europe to adopt a purpose, and of course to enlarge. Well, this is ongoing more or less now, but to enlarge the notion of also of fiduciary duties. So how do financiers and corporates identify key purpose for corporates beyond only servicing shareholders? And so now if we go on proposals, we made some, I think maybe on the first one, on savings and how do we channel them to responsible corporates. We think that one idea, also, it could be a good idea to foster European identity to citizens in our member states, would be to create a new sovereign saving funds in Europe. Not an additional, saving commitments by citizens, but taking part of already existing savings, putting them in a sovereign European funds, managed in a parity, I don't know what we say in English, a way, for instance, with trade unions, as it's done in northern countries or in Germany, and focusing only on responsible investments. And so it would give an impetus, it would give an example, and also an attachment to the EU if such a fund with quite some money could be really, again, an example to follow on channeling savings to responsible corporates in key identified key sectors of activity. And other proposals, key proposals, are also to review prudential frameworks for banks and insurance. Today, we have a contradictory injunction given to banks and insurance, telling them that you should be bold on financing renewables, financing long-term risky investments, in green economy, for instance, or in social commitments, but at the same time, a regulatory framework telling them that, please don't take too many risks on the long term or on risky projects and all that. So we really have to adapt the regulatory framework, and particularly the prudential one, so that insurers and banks can be more active on these responsible projects, long-term projects, and of course, also risky projects. We're talking about very innovative projects. On the second part of our report, the proposals are that we should really be more active on building a European ESG. So we're happy because one of our proposals has already been taken on by the EU, and EFRAG, which is a very specific, specialized body of the EU, acting on behalf of the Commission to make the link with the International Accountancy Standard Board, IFRS, has been officially asked to now think about ESG and to think about what could be a European ESG, and also a regulatory framework for extra-financial rating agencies and ESG purveyors, ESG data purveyors. So this is ongoing. The only thing is that it's there is quite some work to do, and nearly close to philosophical work, in a way that what are the key values we want to be reflected in indicators and in data that afterwards we will ask corporates to report on and to take on board in their accountancy systems. So and it has to go quick. And of course, now when you look at the last report of EFRAG on this issue, and discussions are going at the Commission, the Council level, and also testing with the European Parliament, you see that it will be very difficult to reach any framework before 2024. And of course, it is too slow, because at the same time, on the other side of the Atlantic, you have corporates along with academics focusing on what is their definition of responsible investment, responsible corporates, and their own views on ESG. And they go quick, and they're smart, and they want to be, of course, on this field, because this is the new trend of the economy, and there is a lot of business to be done on this. So they go on this field with the American efficiency. And on the other side, in Europe, you have maybe a too institutionalized discussion. And maybe if we could be able to have more direct discussions with corporates, academics, and of course with the participation of regulatory authorities and political institutions, that would be more efficient. But for sure, there is a battle on norms and on data frameworks, and we should be aware that these debates are very political. If we take only one example, for instance, on the social field, you have one way to think the S of ESG, an American one that is today a majority one. How do you deal with minorities? So gender, sexual minorities, racial, ethnic minorities, and all that. This is in a way easy for corporates because you can produce figures, percentages, but at the same time, you run the risk of adding to segmenting societies and to differentiating between different parts of societies. Another way, more European in my view, is to focus on cohesion. And here you can focus, for instance, on other indicators such as the remuneration scale in the corporate, the pay ratio. You can also think about representation of employees in governing bodies of the corporates, executive committee, the board, we course, and this is really far away from the American thinking at that point. So we can. This is one example to show that we can think about social issues in a very different way, and these are very political differences. and if Europe is not giving the fight on this, well, corporates will be just proposed with an American way of doing things, and then they will apply another responsible capitalism. And of course, on the last one, when I already mentioned some proposals that were to enlarge the possibility of adopting a purpose by corporates in Europe, also harmonize regulatory frameworks around pay ratios and remuneration structures in the corporates, and also representations of employees in boards, for instance. We have many different regulations in Europe, and we would gain, of course, in being more harmonized. So, well, I try to cover more or less all the reports we made. We considered this report as being a first step, a proposal, a pierre à casser, as we say in France. So this is the beginning. These are very complicated issues. We need to think about them. We need to go further on certain proposals, on certain aspects of what we wrote on, and it has to be European. So I think the debate we have today is extremely fruitful and interesting, because we have to confront our ideas with views by others in Europe. The success can only be reached, of course, at the European level.
Yeah. Ms. Potier, thank you very, very much for your remarks. And it's very clear that you are talking in terms of responsible capitalism. You are saying Europe has to refocus on its own model. You have to remodel capitalism. And you are saying Europe should be at the forefront of responsible capitalism. A very clear conclusion. And you delivered several suggestions and proposals. That brings me to a question. Why is it so important that Europe will take the lead? And let me connect that with the question raised by Thomas, one of our viewers. And he says, how would European ESGs differ from the current global ESGs? On what values would or could we in Europe agree that can have their place in the ESGs?
Well, first part of your question, I think that Europe was at the forefront of responsible capitalism. If you think of really the policies of, for instance, sovereign wealth funds or saving funds of northern countries in Europe, they have always been very committed to, even in the Netherlands, you have really financial institutions that have been for years very, very committed to backing a certain the economy at certain conditions, and very committed on social issues and environmental issues, banning some sectors of activity and all that. And the development of SRI in the asset management business has been really pushed by northern countries and by Europe. And when you go elsewhere in the world, Europe has really gained a reputation of expertise and really competence in this field, be it in Asia or in the US. So now, of course, these countries are also committed to responsible business. But I think that it would be a pity and a shame that Europe that has been thinking about that for decades now should lay down and go away in a way when it becomes mainstream. So we have a say. And well, I took an example as far as ESG is concerned. I think on the environmental issue, well, the E is more or less the same everywhere. There is no issue that when we want to fight against climate change, we will count carbon equivalent emissions. And it's not easy to do, of course. We still have a lot of progress to do on carbon accountancy, but there is no question that this is the same indicator worldwide, and we have the same way of looking at things. Even for other environmental issues such as biodiversity, for instance, we might be at different levels of commitment. You might find different political pressure on these issues worldwide in different regions, but we have the same way to look at issues. It's not the same on governance issue and on social. On social, again, I think that there is now a very clear way, American way to look at things in discriminating between parts of society. And I believe that Europe is really wants to look at things more on a comprehensive and in a consistent and cohesion way. So how do we make sure that we reinforce cohesion of societies and not representation in different institutions of segmented and fighting together different parts of society? This is a very big issue, and this is very dangerous. You see to what problems this segmentation of societies can lead. So if at some point we put corporates in a situation where they have to produce strategies and figures corresponding to this conception of segmented societies, we have a problem. And on governance, again, if you propose to American investors and or pension funds or whatever, well, even though that you have very committed pension funds in the US and for instance, saving funds on the east side and in the west side, but to many actors in the US, if you tell them that employees should be represented at boards and they should have a say, well, they feel that this is communism. And we feel that it is not. We feel that it's it's a more inclusive way to manage corporates and to make sure that it's one very important stakeholder, and it is one way to really associate these key stakeholders to the corporate, to the management of the corporate. So, and we can find some other examples. I'm not saying that Europe is responsible and America is not. This is not true, of course. And we have many common ground, but some parts of the are quite different.
Thanks. I have already some other questions, but I will come back to it a bit later, because here at the table in Amsterdam we have two Dutch guests. I'm very honored that Nora Notum is here. She's senior economist at ABN AMRO, and you're also teaching and researching at King's College in London. And Mr. Bert Colijn, senior economist of ING Bank. So great you're here. And please, can you reflect on what has been said now? And you will start, Nora. The floor is yours.
Thanks a lot. So first, Mr. Potier, thank you so much for your presentation. I very much agree with the problem setting that you did. Not always agreeing with the solutions, however, but that's why we have this panel conversation, obviously. So much of what you've been saying reminds me of a speech of Mark Carney. He's the former governor of the Bank of England. He once had a speech about the tragedy of the horizon. Not sure whether you read it, but basically what he was talking about is short-termism. And I think when you refer to, money to responsible companies, short-sightedness of investments, that's basically what you're referring to as well. So short-termism is basically that investors prefer short-term profitability over long-term investing, and therefore not investing in climate reduction policies. So obviously, like investments in climate need a long-run horizon. And if you look at the investments that are done, especially by banks, are much more focused on the short term. So banks obviously have a more kind of 3 to 5 year horizon, but if you look at climate change, that needs 20, 30, even 50 years. And the point I wanted to make here is that I think it's not necessarily the issue of the duration of the investments. So let me explain this. So basically investors, in theory, they look at the net present value, right? They want to maximize the net present value, even though if it's a short-term investment or a long-term investment, that doesn't really matter. So it's not about the duration that investors prefer short-term investments over long-term investments. It's more about calculating this net present value. And I think that's a really core issue, and that's an issue that you also mentioned in your speech. How do we incorporate climate risk into the net present value? That's obviously very, very complicated, right? Because we don't know what will happen in 10, 20, 30 years, and especially not related to the climate. So I think this is something that we really have to strengthen our capabilities on. And one thing that I think is important is the data quality. I think you quickly mentioned that in your presentation as well. It is just very hard to see if a company truly and honestly wants to invest in ESG, or whether it's more like what we call greenwashing. So basically saying they have all sorts of sustainability targets, but not really committing to it. And I think that's really important. And credit agencies can play a major role in that, accounting standards, obviously, but also making sure that ESGs are really integrated in how we evaluate a company. And therefore also the valuation over long term, and therefore these long-term investments that really mitigate climate risks, therefore turn out to be a profitable investment. So I think that's one of the first points I wanted to make. The second point, and that's actually related to the question that was just asked about the S in the ESG. S standing for social, obviously. I do agree that much of the, how we look at that notion, social, is basically in an American way looking at social issues. However, I think it will be really hard also within Europe to have a common definition of social. Because obviously what we think as, social goals here in the Netherlands differ very much from Greece. And that on itself differs very much from Hungary, for example. Look at the LGBT issues that we're now facing. Hungary opposing the Netherlands in terms of minority groups. And I think having a common European definition on social will be a really tough challenge. And I really wonder how you look at that, because obviously we don't want the American standard, but is it even feasible to have a European standard of social investment? So that's, I think, the major points I wanted to make. But to come back to the speech of Mark Carney, I think really the key issue is coming over this short-termism and really look at the long term, because that's the horizon that we have to target in order to mitigate these climate risks. That being said, I look forward to your response.
Thanks, Nora. And now it's your turn, Bert.
Thanks very much, and thanks very much for the very interesting presentation and paper written by Mr. Potier. It's been a pleasure to read, and a lot of interesting ideas to be taken from there. A few points on the what really triggered me out of the presentation, starting with perhaps basically the ground for all of this. I think very important base for the work that you've done is the fact that we have so much savings, the fact that investors are investing in government bonds as opposed to in corporations, in fruitful investments. I think that is a European but also a very global issue that we're dealing with, that relates to, as already mentioned by Mr. Potier, it relates to demographic issues that we're currently dealing with, but also issues around productivity that have been very weak. And I think that there is a very big question lying beneath how we're going to spend it, which is why are we dealing with all of these savings? And perhaps the answer to how we can spend it also relates to why did we end up with so much savings in an economy to begin with without fruitful investment opportunities? And I think that in that regard, looking at Europe, I think that we're identifying the right issues for quite some time already related to demographics that have slowed the longer term potential of economies, that make it less attractive to invest in fruitful, tangible investments in an economy as opposed to investments in financial assets or investments in safe assets like government bonds, for example. What we should think about is how we can make sure that Europe becomes an attractive place to invest in on its own again, not just for putting financial assets, but also just to make sure that we can get productive investments into the economy going. And I think that, of course, that is the base of the work that you've been doing so far. But I think it could be worth pointing out as well that issues related to increasing and enhancing productivity are going to be key in the coming decades to make sure that Europe remains an attractive place to invest money. And for that, we know, of course, that we can make improvements on product market regulations, on labor market regulations, but also on doing the right investments to make sure that Europe can become a modern economy that is useful for investing into. And it is important that that remains a key focus for policymakers to make sure that we have a fruitful base to invest in. Besides that, of course, you put a lot of emphasis on the regulatory framework that allows to invest. And I think that in that sense, we have also identified the right issues. I mean, Europe has been working towards having a banking union and towards a capital markets union for quite some time already. And the progress on that has been excruciatingly slow. But of course, the issues that lie beneath this are very difficult to resolve in economies that are so diverse and financial systems that are so diverse within Europe. I understand why it's taking long, but that doesn't mean that we need to take more time moving forward, because to move up from the 6% invested in France directly in corporate bonds or equity to the US numbers of about 30% that you mentioned, Mr. Potier, are very important to have a fully functioning European market for capital. And I know that there are risks that come with that, but ultimately a solid base needs to be created for capital to be allocated more efficiently than it is right now, which in Europe, in fact, is less efficient than what we see in the United States. Then finally, the question of, okay, so if we have the incentive to invest and if we have the right regulatory framework, then of course you focus a lot on whether we are investing in the right opportunities and the right companies that are sustainable and working towards a fruitful and sustainable economy in the longer run. In that regard, maybe, and it's interesting that Nora was mentioning Carney, because I think that central banks are starting to become a perhaps surprising ally in the fight that you're working on. And it's been quite encouraging how we've seen quite a significant turn being made from a very strict and narrow 2% inflation target that central banks are working on to something that is likely to start to incorporate much more climate goals that are indirectly working towards durable and sustainable inflation at a moderate pace of around 2%. We're seeing a lot of new incentives or a lot of new targets being issued, and we're not really sure yet where the ECB is landing, but their strategic review is about to come to an end quite soon. That will likely incorporate quite a few ambitious climate targets that could provide a lot of incentive for investments to end up in more sustainable and environmentally friendly parts of the economy, which I think could be quite a radical change that lies ahead of us, that we're not sure of how that's really going to impact financial streams, but makes me quite hopeful. And I'm interested to see how you, Mr. Potier, are thinking about that.
Great. Nora, I have a question. After Janet Yellen's proposal, a global minimum revenue tax of 15% is now within reach. But of course, nations or regions can go higher than 15%. Do you think a European social minimum value is feasible for the social and ESGs?
Well, obviously it's feasible if you want it, right? So that means we have to basically get our hands together on a European scale in order to get that done. And the thing is, like, when you look at these climate issues, you always have, the carrot or the stick. So do you want to incentivize companies, so the carrot, to reduce carbon emissions, or do you want to use the stick? So that's, for example, taxing them, carbon tax emission, for example. And well, I think we've done a lot with the carrot so far. So we've really tried to incentivize companies to do the good thing. But at some point, if the carrot doesn't work, you have to go to the stick. And I think from, literature and academic research, it's very well established that carbon taxing works. So that being said, if we can get our hands together in Europe, and that's a big if, right, then it should be feasible.
Yeah. Ms. Potier, can you give a brief reaction on the remarks of Nora and Bert? Brief, please.
Yes. Well, I fully agree with most of what has been said, and it's true that this focus of net present value and the way we calculate it is absolutely fundamental for the structuration of investments and the pressure put to corporates. At the same time, I think there is still an issue of duration for this particular period we're in, because since we're in transition, many corporates will be confronted to remodeling their business model, and this takes time. It takes a bit of time, and they will be led to taking risks on their business model, on their strategy, and if they want to carry that in a orderly and efficient manner and rewarding manner, they will need to be backed by their investors for some time. And if they are challenged in some month or even at the end of 1 year after some decisions, because investors think that they cannot find rewards and returns and all that without waiting enough time for these new strategies to be in place and to give their results. Then it will be very complicated for corporates to lead these transition periods. So that's my BMO to this duration issue. And I fully agree also, of course, it will be very difficult to have a one S fits all. I mean, at the same for G. At Amundi, it's true that we would like to have a worldwide framework that our portfolio managers could deal with, and it would be very easy. But if we want to be efficient, if we want to have an impact, and if we want to be at the same time connected with local ways of doing things and regulatory frameworks and all that, we also have to be to adapt ourselves and to be flexible, at least at some point, on the S and the G. So I guess you're probably right. We should find not an easy, but we should find a way to at the same time find for European views on ESG and particularly on S and G, but at the same time being aware that it shouldn't be some sort of church, giving a one-size-fits-all framework, a political framework to all member states. That wouldn't work. And I think that on the other set of questions, you're particularly right, of course, also that the question is that how Europe can propose rewarding and productive investments opportunities to its savings and to other investors worldwide. And here, well, you have these recovery plans and Next Generation EU. So we have an opportunity to use all the money we're putting in rebuilding our economies to put this money in the right places. So some sort of conditionality, of course, on social issues and environmental issues, environmental and digital transition. This is already, of course, taken on board, but we have to be smart on this. And you have a competition, of course, today on these recovery plans between the different regions, between Asia, Northern America, and Europe. I think that will be key, and I'm very optimistic also in the evolution of central banks' activities and framework of actions. We know that there are a lot of debates, but they've taken a new route, or at least on environmental issues, on climate issues, that is very interesting and that might help us.
Thanks. Now it's good to go over to our panel conversation. Let me start with saying something in general about European developments and the position of Europe. if we are reading, Mr. Potier, your report, you can see that the three parts are severely intertwined. We cannot have a responsible capitalism without long-term orientation, but we cannot have a long-term orientation without the right information and legal standards. And this truly requires a big reorientation for European capitalism. And the question is, of course, what are the possibilities to realize this situation now that we are on the brink of the post-COVID period? And then the question is, what is the unicity of Europe? Are we only talking about Europe because of the current geopolitical situation, an external threat? Or is there also some intrinsic value in the old continent? And how is this seen or translated in the economy and the financial sector? So this is a more general question about Europe, and maybe, but can you reflect in the first place? Then I go over to Ms. Potier, then to Nora.
Absolutely.
And of course, we have to be a bit brief. We have a lot of questions. Also, people of the audience are bring up their questions. So let's to be concrete and specific. But
I mean, the old continent sounds very much like we're only museums and beautiful touristic sites anymore, and that I think is too pessimistic about what Europe has. What Europe is. I think that Europe is a place that is just besides geopolitical threats. Already the level at which we have to look from an economic perspective. And I think it's been so for quite some time. The way that globalization has changed the world means that Europe has become the natural level for us to compete at, and that economies on by themselves are much too small to work with. And I think that the first things that we see coming out of Brexit are a good example of that.
Yeah, Mr. Potier?
No, I would say that the European model is very attractive. We should be proud of. We have many problems, of course. It's not easy to be all together and to manage collectively part of our things at Brussels. But this is a very attractive model worldwide. So we should be proud of it and we should defend it. And this social market economy, économie sociale de marché, as we say in France. With this responsible corporate finance and capitalism is absolutely key. And also we should think what kind of new pact, what kind of new cooperation we could build between corporates, society, and governments. And I think Europe could be really interesting and innovative on that part. And when we say Europe, it's interesting for Europe, but again, it's interesting outside Europe because our model is attractive.
Yep, thanks. And Nora, or should I say Mrs. Notenboom, do you prefer?
Both is fine, or it's fine.
Okay.
Yeah, so the unicity of Europe, I think, especially in this context, Europe has two major benefits. And the first being that from an economic perspective, we're not so much market thinkers. So in the US, economists and especially think tanks on the conservative Republican side, they really look at how can we diminish the role of the government. And I think, solving climate-related issues is really a cooperation between governments and corporations. And therefore, public-private partnerships are crucial in the solution. And I think Europe is much more inclined in how we think about the economy, how we want to, distribute economic welfare amongst countries is just much more into a public-private partnership. And I think that's a major benefit. And the second point is that, on the well-being terms, on the social terms, we are doing really good. So the most happy people live in European countries. If we look at more kind of broad definitions of welfare, European countries are in the top 10. So I think from that perspective, Europe is really a unique place and also a really great place to start this conversation and really get it further.
Okay, thanks. Let's start with the first part of the report of Mr. Potier, and that is about the term, the Great Reallocation. Actually, it comes from the Bank for International Settlements, and Augustine Carstens, the general manager of the BIS, stated that there is a necessity to steer the reallocated resources, including human capital, towards sectors that will genuinely benefit the economy in the long term. This unprecedented reallocation will require concerted action by all stakeholders, private and public, including debtors, creditors, central banks, fiscal authorities, and many other governmental agencies such as tax authorities, courts, social security administrations, labor departments, and subnational governments. Of all stakeholders mentioned here, who can and should make the first or strongest move? Should we expect governments to step up, as for instance Mariana Mazzucato is suggesting, or is it naive to think that only governments can and should lead the way? Mr. Potier.
Well, I think, or maybe I didn't hear it, but regulatory financial authorities are missing in the list. And I think they should be at the forefront, because if you want to manage a great reallocation, you should authorize financial institutions to do it. And nowadays, with the prudential regulations, they can't. They just can't. They can't put a lot of money in long-term risky business. This is just not allowed. I mean, capital requirements are way too heavy nowadays. So we have with political authorities and regulatory authorities to find a way, of course, still protecting savings and not taking too many risks, but still letting financial institutions play their role and managing risk, allocating savings to these new key sectors. And apart from regulatory authorities, of course, public money should be an example. And when we say public money, I'm talking about budgets. I mean, today, states don't really have green budgets. Well, they should. Central banks and recovery plans. And maybe the last part is okay so far. I mean, there you really have focus on key sectors with requirements. And to be smart in defining the priorities, I think this should be discussed with business. It shouldn't come only from civil servants and politicians. It should be very pragmatic and very linked to the capacity of the productive apparel of corporates to be able to answer these requests.
So it is not only a matter of governments, you also need those responsible business and so on. You're very clear. I suppose that Bert and Nora agree with that. Let's go over to another question. We have concluded that there is a major division between the financial sector and the real economy. And one key issue to the concept of the Great Reallocation is therefore, how do we incentivize capital owners and capital holders, including pension funds, investment funds and insurance companies, capital makers, including governments and central banks, and capital intermediaries, including banks, to invest their wealth consciously and responsibly for the long term in the real economy? And then the key question is, do we need stronger enforcement rules and regulations, encouragement, for example, tax incentives, or should we hope for some kind of moral recovery? Let's start here at the table. Who wants to reply?
Well, I think the moral recovery is underway. I think that we see it in a lot of aspects of the economy at the moment. That there is a very clear focus on social responsibility, on environmental responsibility in terms of investments, and it has gotten into the public eye as well, where there is big discussions around where money is invested, ranging from pension funds, which is very topical in the Netherlands this week only, to how money is invested via banks. I think that is definitely encouraging, and I think the question is how you can get as much clarity and openness about how responsible money is really invested. And I think that's probably where we could get good next steps around whether a green label, and Nora was already talking about greenwashing earlier. I think that's a big element of this, of course, is how can we make sure that a green investment is indeed a green investment. I think that's where probably next steps are important to be taken.
And Nora?
Yeah, so I completely agree with what Bert just mentioned. I think also during the COVID crisis, all these points have really come to the forefront, right? We kind of noticed how important it is that our local livelihoods, the shops around us, parks, basically where we live, are just being well maintained, as well as the health system. And I think, this whole COVID pandemic, which was on itself a terrible period, but really brought us forward in especially these things that are important for us on the social and environmental level. So indeed, I think companies have done much more on social responsibility, ESGs, and that have been strengthened by COVID. I think now especially we have to look at how do we quantify it? How do we make sure that companies really keep up to their promises and indeed that they don't kind of resent to greenwashing, but that we really, really make sure that we reach these climate targets.
Great. Mr. Potier, talk about moral recovery. How strong will it be? What do you think about it? Because you talk about responsible capitalism, there must be a connection with moral recovery.
Well, I don't think that today it's very complicated. If you want to do greenwashing or social washing, it's very complicated, and because you're challenged by society, by social networks, by NGOs, and all that. And transparency, we get it more and more. So I agree, it's key, of course, so that everyone is confident in the way the system was working, but I think it's already underway. So and when people say, "Oh, but this is not sincere," for instance, this corporate is not sincere when it talks about its social commitments or green commitments or whatever. I don't think this is the right question. Sincere or not, it has to be efficient. It has to be right. It has to be just. So, and when there is an alignment of interest, this is the best, because here you can be sure that it will last, because every stakeholder. So, the key question today, I think, for corporates are the way they will arbitrate between their different stakeholders. Who gets what? I mean, the share of value creation, and this is when the corporate is suddenly aware of its that it became a political institution in a way, and that it has to take into account different stakeholders. Then it has difficult arbitration decisions to make. To what extent I'm going to serve these stakeholders, or these are the ones, etc. And it has to be clear. It has to be, of course, trusted and understandable by everyone. I think that's where we are today. And if we want things to be particularly clear, and the next step, I would say, is the enlargement of the accountancy scope and the integration in accountancy of all these extra financial, so to speak, because they are not actually extra financial, but issues. So how the corporate is really taking them into account in the way it documents the life of the corporate, the value creation, and hence how it shares these returns.
Mr. Potier, there is a question from Cor, one of the people watching. And Cor says, how does Mr. Potier see the position of the Netherlands in Europe?
I spent some years in public administration in the French Treasury, and I was always amazed. I take the opportunity, because our German friend is not here, that at that time, some years ago, we would be forced to find common ways with the Germans, and it was always very difficult. And strangely, politically, it was always very difficult with the Dutch. And at the same time, on issues, we spontaneously we would very much agree. So I was always amazed between concretely many common views, actually, even though politically you could have a feeling that we would be on different paths. And my experience on ESG, on responsible investment, and all that has always been that the Dutch were very much engaged, committed, and in advance. And you have very nice institutions with a lot of competence and expertise for some years in this issue. I view the Netherlands somewhere in between Middle Europe and Northern Europe on these issues.
Yeah, thank you.
Which is correct geographically.
Ms. Potier, you suggested to finish and strengthen the capital markets union, and the question is a bit: what kind of safeguards are possible or necessary to ensure that the capital markets union will work in service of the necessities in the real economy?
I think it's, we're too much criticizing financial institutions for not serving real economy. They are serving real economy. They do transform savings and short-term money in long-term investment and financing. They do it. But they've been, of course, criticized because maybe they've gone too far in playing with markets, which also can be very useful by the way, in serving the real economy. So it's most of the time it's an issue of really knowing what's happening, and of course recognizing, acknowledging by financial institutions that they had been too far before the financial crisis of 2007 and 2008. But my feeling is that for the last 10 years, and the shock was so severe in 2008 that financial institutions have made a lot of progress in being responsible and in regaining confidence from society. So obviously, this is not entirely done, but and particularly in Europe, again, when you look at banks, for instance, in Europe, and their commitment to green investments, with so much ahead of the American ones or the Japanese ones, for instance, there is no debate about that. So I think that today, when we talk about capital market union, it's not a question of protecting and savers, investors, or really making sure that the money goes through the real economy. We have many regulations in Europe. It's more a question of consistency and a question of making things easier so that money can go in an easier and more transparent way at the European level. And today we have fragmented markets, and they are not efficient. So even if they want to go to the real economy, they would be much more efficient if they could deal at the European level.
Yeah. Let's talk a bit about the second part of the report. And Ms. Potier, you are referring to the necessity of the standardization of extra financial information in Europe, including ethics. And we are, of course, all aware of the discussion about integrated reporting, ESG standards, and compliance to the SDGs. But this development might also have negative side effects. One of regulatory deadlock, when we will have so much regulation and standards that normal business will be almost impossible. We are already seeing this in the banking sector. New entrants are scarce, and small banks are finding it hard to survive. And two, the outsourcing of ethics to rules and regulations. Is ethics not larger than legal and accounting standards? I think it's a very important issue. Who wants to reflect to start with? Nora or Bert?
Perhaps. I mean, I think that ethics are, of course, very important, but it's very hard to regain trust, of course. And I think that that's an issue that we've seen since 2008. That's resulted in a lot of regulatory burden on the financial sector. Of course, justly, because we clearly needed more of a regulatory framework to make sure that the mistakes of 2008 wouldn't be made again. At the same time, it does come with a price, and indeed the price is that it stymies investment opportunities as well, and brings a lot of burden on a sector that makes it harder to efficiently allocate capital because of that. And I think that in that sense, it's important for ethics to at some point be seen somewhat wider. But of course, this is hard to see without the context of 2008. And the question is how that at some point is going to be be dealt with in a more efficient manner that serves society better than the way it does at the moment.
Yeah, Nora?
Yeah, so obviously ethics is much broader than legal standards. So just let us be clear about that. So basically, if you think about ethics and what it is and how we can incorporate that in kind of the business processes, I think we have to also look at education, right? So a lot of people that are now CEOs of large banks, of large companies, they did like business studies, economics, and basically the ethics, the studies of ethics is something that's basically philosophy, but it's not incorporated in economics or business studies. And I think we should really rethink how we think about, training CEOs and training these people that lead these large corporates and giving them already on a younger age kind of ways to think about how to lead a company besides making profit. And I think ethics in that sense, well, obviously you can try to fit it in legal frameworks, but it's never gonna be workable for companies to do that fully. So I think ethics is just a really important aspect. Also kind of getting people's mind around what ethics exactly is.
Yeah, and Mr. Potier?
I absolutely fully agree with what has been said, and I would even go, of course, much further than CEO. We have to train all the way down the corporates. Ethics. This is very interesting because it shows that we should do things differently than they've been done until now. You have a very established way to do things and more American one, which is compliance. So box ticking. So you have some requirements and you make sure that, okay, you answer the box, that's it. And when you talk about ethics, it's fundamentally in a bank, for instance, it's how any employee in the bank put to some complicated situation will have a sound reaction and reflex. So, and this is not lying with knowing a huge ethical code or a compliance code or whatever. It's really having in mind, okay, the fundamentals. So this requires, this is cultural, this is training, this is, you have different ways to do that. But, and here again, you have a lot of efforts that have been made by banks and financial institutions in Europe lately in the last period to go beyond compliance and making sure that ethics is integrated in the entire corporate. So, and this does not, you can talk about ethics when you're small, medium-sized, or big corporates. Of course, this is a different thing to overwhelm corporates with a regulatory request and compliance requests. And sometimes I agree, it's become really ludicrous. We spend a lot of money and time and resources on compliance with no results, or really not at the level we should expect. So we have to turn things away and maybe have a more cultural approach to this. But this means that we also have to get this discussion done with regulatory authorities, so that there is an understanding between regulatory authorities, judiciaries, and corporates, so that we, at the end, we all want to fight for common goods and to stay away from, for instance, slavery, corruptions, all that. So there is no question about that.
When we talk about these standards, I think we have to speed up the developments, because we are talking now rather long about all the standards, and there must be clarity. I think this is important. And I remember also the interview of Peter Bakker, and you know him, he's the president of the World Business Council for Sustainable Development. And once he gave an interview, and the title of the interview was "Accountants Will Save the World." And we liked it, but it was about clarity and honesty and measurement and the willingness to reflect on what has been done, what went well and what went wrong. I think it's very good to be precise. And it brings me to another question. Ms. Potier is explicitly referring to mainstream accounting and legal standards as Anglo-American standards that differ from core European values. Quote, "Accounting information is regulated on the basis of standards imposed by the United States and extra financial ratings are in the hands of American agencies. European capitalism, therefore, needs a framework of standards proper to Europe. I think this is an important element. Who wants to reflect? Bert?
Yeah, I think this is very interesting, but also at the same time, the pragmatist in me thinks, boy, how are we going to unravel the system that we have already created? Because it is so hard in the globalized world, at least for multinationals operating from Europe, to get around from how this is currently organized. And American or Anglo-Saxon standards are currently a reality that we need to deal with. So in that sense, I would say it is admirable to think about this, and I think that there's definitely something to it, that it could reflect our values better, the standards that we're working with, but at the same time, difficult to deal with.
Yeah, Nora?
Yeah, maybe to add to that, because I'm a pragmatist myself as well. I think obviously like S&P, Moody's, much kind of focused on American values. However, we know how important these credit rating agencies are. We've seen it in the financial crisis, right? Much of the issues started with the wrong ratings from these credit agencies. So I think rather than kind of trying to make a European counterpart of these credit rating agencies, I think we should just discuss it with them, because they are not making credits only for American countries. They're making American companies, they're making credits for basically every single company in the world. So I would rather, try to discuss that with these rating agencies instead of, trying to compete with them. So I think better just to cooperate with them instead of competing.
Yeah, and Mr. Potier?
Yeah, two very quick remarks on the first aspect. Well, the IFRS, we apply them thinking that the US would apply them, and they did not. So it was a race by European corporates on other accounting standards to get the American money on American markets. And at the end, we bought, so to speak, a standard that is not the American standard. So I think we could be much more much freer regarding these standards, and rethink them in a less short-term aspect. At least, but this has started at least on some aspect of prudential issues and even on accounting in Brussels to rethink part of this IFRS. On the other part, I fully agree. We could think that, okay, we're going to create a European extra financial rating agency. Well, what's the point? It will be very difficult to compete with those big guys, either credit agencies now doing also the ESG or MSCI. So one very interesting option is just to regulate, just to make sure that they are transparent enough, that they focus on this and that they give access to raw data, that they avoid conflict of interest, all that. So this is one proposal that has been made by ESMA. So I think that this is debate ongoing in Brussels, and I think this is a very practical and option that would be interesting, efficient, and quick.
Maybe it's also good to underline the fact that if you talk about the SDGs, for example, or the Paris Climate Agreement, or the necessity of a circular economy, these have global dimensions. And that's in fact your remark. I agree with that. That brings me to the third part of the report. And Mr. Potier, you are favoring a legal framework in Europe that pushes businesses to define their social and environmental objectives as well as their raison d'être, or the purpose that you advocate for. And this is a very fierce discussion in the Netherlands at the moment. Is it possible to enforce this kind of law? It seems that competition from other parts of the world will surely benefit, putting some European business in serious trouble. It might even lead to a replacement of headquarters by some multinationals. Will that not be counterproductive? Mr. Potier.
I don't think so. I think it shouldn't be, of course, obligatory. compulsory. It should be an option given to corporates. Interestingly, in France, with the recent loi Pacte, that gave the option of adopting a raison d'être by corporates, you have now 2/3 of CAC 40 that adopted a raison d'être. And why did they do that? Well, one of them, done on a very specific case, did it because they have a very volatile investors and structure of their capital, and they wanted to defend the way they're doing their business and their commitment on social issues. But and by the way, to protect former managers of the corporates. But if you do it in a normal way, so by this law pact, it's just an option given to corporates so that they can think over with their different stakeholders and particularly with their employees, what is their usefulness to society? How do they fit to society? And it's an opportunity to reflect on their business model with the different stakeholders. And actually, even more important than the result of this raison d'être is the making of the raison d'être. How do they reach this purpose, this definition of purpose? And all of them thought that it was a very interesting process by which they regain some commitments by their employees, and they could refocus on their core strategy. So I think that it's on the contrary, it could be an advantage, a competitive advantage.
Yeah.
But
Nora?
it shouldn't be, of course, compulsory.
Thanks. Nora?
Yeah, so I think in this context, it's important also to mention kind of the pink elephant in the room, right? So tax evasion and tax havens. I know Netherlands is obviously on the list of being a tax haven. And I think in this respect, it's really important that we try to counteract that as well. If you look at FDI flows, inflows and outflows, in Europe, much of it's going to Barbados, the Cayman Islands, and that's not because we've got very productive manufacturing over there. That's just because of tax evasion issues. And I think that's really relevant in this respect as well. If you look at like a common framework, make sure that you kind of diminish these flows because they're not productive and not going to the right resources.
Okay, I think we should stop now with these three remarks. I have a question from our viewers, from Thomas, and he said, when talking about the Great Reallocation, are central banks not the elephant in the room? Can we ever get to a recovery of the real economy under the current policy of quantitative easing? Mr. Potier.
Well, I'm not a central specialist, so but what we can tell is that if we're talking about reallocation, they should play a role, and they should be more selective, maybe in the way they put all this money on the market. It's true that now we have a lot of money all around. We run the risk of having bubbles, that's for sure. But at least if there is some focus on don't go beyond green and digital, for instance. Let's stick to that. Even let's stick to green only. That would help a lot. And it's true that when you look at the structure of bilan, I forgot the name, of central banks, there is too much carbon. So, but here again, I think that you have this network of this greening financial the greening network of the central banks. You have recent position taken by the European Central Bank, by the Bank of England. So I think it's underway that they will maybe take some distance with the traditional not mingling with and this sector neutrality of their action. They understood that they were also under strong expectations by society. They could not avoid the debate.
We have to finalize a bit of discussion. A brief round. We have been discussing many issues, and thanks for your participation in this. It was great remarks. The key question is always what is the central message? If you would have now an article in newspaper, what should be the headline? What's your key message after this discussion? Let's start with Bert, then to Nora, and then to Mr. Potier.
Maybe let's take a positive note on this. I think I think what we've seen happen over since the COVID crisis, but perhaps also already before, is that we're getting more and more to addressing these points, and the points are very broad that Mr. Potier has addressed in his report. And I think that looking at it from the investment perspective, some exciting things are happening, especially when looking at the recovery fund that Mr. Potier has already alluded to. I mean, we see that money is being allocated to parts of the economy that we have agreed are important for the future, and this will be a very important litmus test for whether governments can have a decisive role in this, and it will be exciting to see how that will work in the coming years.
This is a rather long headline, but
That's a long headline.
Nora?
Yeah, we're all about long headlines here. So I think perhaps one takeaway is that these structural changes that we've seen, looking much more at social investing, much more at climate, much more also in interacting in companies and interacting between actors, companies, the government, but also employees. And I think that's just a really good development, and this development should be kind of speed and put forward in the coming years. And I think regulation can play a big role, accountancy standards, but there's also the mindset. And I really think that the mindset now amongst employees, amongst employers, is that these ESG goals are important. And I think that's just the big kind of elephant in the room. As long as everyone is on the same page and looking at the same kind of future, then you can really start making changes.
Yeah. Thank you very much. Mr. Potier, last one.
Yeah, well, I think that we know that we can have capitalism more responsible and more efficient for everyone, for every stakeholders, and there is a widely shared awareness that we can change things. So let's get to the business and let's cooperate between corporates, governments, and society, because it will only happen if we do things together.
Thank you very much. I think it's good to focus now on a takeaway in 5 points. And the first is Europe is facing a multitude of challenges: geopolitical, social, ecological, demographical, and of course recently COVID. We must conclude that we cannot address these challenges within the current economic paradigm. Structural changes are necessary. Luckily, Europe has its own tradition of Rhineland capitalism and the social market economy, to which we can turn for inspiration again. 2. If we wish to enforce structural changes, we need a reallocation of resources. Savings and investments are currently predominantly directed towards the financial markets with short-term objectives. And what we need are long-term investments in the real economy. For infrastructure, innovation, European small and medium enterprises, climate transition, etc. And finance must be reconnected to the needs of our societies. And that requires a change of values, of paradigm and thinking, but also a change of concrete measures and policies. 3. Many companies are willing to make ESG and CSR criteria a central component of their organizational purpose. However, they are hindered by financial structures and fiscal, political and technical measures. And we can conclude that it is also the structure of the European financial economy that benefits short-termism. We do not want to recede into complete protectionism or regionalism, but we must find ways to safeguard our companies and institutions from aggressive investors from other continents. And we must find ways to stimulate creditors to not let their investment strategies be dictated by anonymous markets. 4. Governments can make a big contribution. For instance, as was stressed by our speakers today, by reversing tax systems that now favor equity over debt financing, by introducing accounting and prudential standards that include European values and support long-term investments, and by enforcing legal standards that support European capital being used for European sustainable and long-term investments. And 5. But it is not a task for governments alone. To quote Augustine Carstens from BIS, this unprecedented reallocation will require action by all stakeholders, private and public. Europe urgently needs people who want to engage with the promise of a humane society and capitalism with a human face. Leaders who care about the future of the continent's economy and society. Politicians, CEOs, business leaders, academics and individuals with a sense of place and belonging. We believe that this European turn can only be the result of a voluntary cooperation between European financiers, entrepreneurs, government, civil society and academia, based both on rational calculation and an awareness of a shared interest and common purpose in the long term. Luckily, we are not at the end of the conversation. We are looking forward to the end of this year when we will have the presentation of our own report on the future of the market economy in Europe. And hopefully, the report can contribute to this debate and inspire leaders to engage with the promise of European capitalism. And in the meantime, we will be in touch with the Konrad Adenauer Stiftung, Comité Médicis and Institut Montaigne to continue this European conversation. Some final words for thanks. Thanks to the speakers, Stanislas Potier, Nora Nuitenboom and Bert Colijn. Thank you very much. I enjoyed your remarks. You have done a fantastic job. Thank you. Thanks to the audience for watching and posing the questions. And last but not least, thanks to our partner organizations, the Konrad Adenauer Stiftung in Brussels and Berlin, Institut Montaigne and Comité Médicis in France, the Goldsmeding Foundation and the Free University in Amsterdam. And I want to thank Kees Buitendijk, Cor van Beuningen and Professor Govert Buijs. Thank you very much. I hope you have a great day. Thank you very much for watching us and for the discussion. And I hope we will meet soon again. Goodbye.